Thanks very much, Mr. Shkalien. Dr. Hartwig, over to you.
Thank you, Senator Whitehouse, Ranking Member Grassley, and members of this committee. Good morning. My name is Robert Hartwig, and I'm a Clinical Associate Professor of Risk Management, Insurance, and Finance at the University of South Carolina. And prior to joining USC, I spent 23 years in the property casualty insurance and reinsurance industries, during which I had the opportunity to work on a wide variety of issues related to the industry's exposure to catastrophic loss. Let me get straight to the point. The insurance industry is not in the midst of a climate-driven crisis, nor is it about to fall. Strength and stability are the hallmarks of this industry. Indeed, a recent report from AM Best, the largest insurance rating agency in the U.S., found that the cumulative impairment rate of AM Best rated insurers over any 15-year period from 2001 through 2023 was just 0.3%, down significantly from the 3.9% over the 1977 to 2001 period. In other words, there is no evidence that the industry is on the precipice of collapse, despite material increases in insured losses arising from natural disasters over the past quarter century. There are also no insurers designated as systemically important financial institutions, or SIFIs, and since 2017, the U.S. Treasury's Financial Stability Oversight Council, FSOC, has effectively ceased relying on non-bank SIFI designations for regulatory purposes. Examining the data collected by this committee, which I received just yesterday, on non-renewal rates for homeowners insurance revealed that a small increase in non-renewal rate for the U.S. overall is largely driven by two states, Florida and California. The same pattern of increase is not observed in other large disaster-prone states such as Texas and New York. Suggesting that there are idiosyncratic issues that play a major role in determining insurance availability and affordability in both of those states. In the vast majority of states, 99% plus of homeowners are able to renew their policies each and every year. Climate risk is an important determinant in the cost of insurance, but there has been a tendency, however, to over-attribute the impact of climate change when describing the state of insurance markets. The dynamics of insurance markets are far more complex than can be explained by climate change in isolation, with insured losses and ultimately the price and availability of coverage determined by a range of factors, including rapid population growth and urbanization, inflation, litigation, and fraud. To take population growth as an example, since 1970, the U.S. population has increased by 65%. In catastrophe-prone states, it's been far more than that. The population of hurricane-prone Florida, for example, is up 217% since 1970. In the Cape Coral-Fort Myers metro area, it's up 620%. Why do I bring that up? Because it's unsurprising that when Hurricane Ian made landfall in that area just 2 years ago, insured losses totaled some $55 billion, making Ian the second most costly natural disaster in U.S. history. This example vividly illustrates the dominance of demographics over climate change as a driver of insured loss. Let me move to inflation. Inflation in the U.S. in recent years reached the highest level in 40 years. Inflation directly and immediately impacted the cost of repairing and rebuilding structures damaged not only by natural disasters, but property claims of all sizes by all major perils throughout the country. Inflation, as experienced by property insurers in recent years, is actually materially higher than that as measured by the CPI. From January 2020 through June of this year, the cost of construction materials increased by 41%, nearly double the 21% of the CPI over the same period of time, whereas home insurance premiums rose by approximately 18% over that same period. So again, the economic impact of inflation on property insurance claim costs dominates any impact from climate. Let me move on to litigation and fraud. Litigiousness and fraud have also contributed to the upward trend in claim costs, driving premiums upward and reducing coverage options for some policyholders. According to the Florida Office of Insurance Regulation, that state accounted for 76% of all homeowners insurance-related litigation in 2021 nationwide, despite accounting for only 7% of homeowners' claims that year. Excessive litigation contributed not only to higher premiums in Florida, but a more than doubling in the policy count at Florida Citizens, the state's insurer of last resort. The recent leveling off in the number of policies in force in Citizens is early evidence that reform legislation passed in 2021 and 22 is beginning to improve insurance availability in that state. So let me summarize by saying that insured losses from natural disasters across the United States continue to rise, and they will continue to rise for the foreseeable future. Climate change drives incremental system costs, but the dynamic of insurance markets are complex. Many factors have contributed to the record and near-record losses experienced in recent years, including demographics, inflation, and litigation. Meaningful reforms coupled with investments in mitigation are proven solutions that can help ensure the stability of insurance markets across the country. Thank you for the opportunity to testify before the committee today. I'd be happy to respond to any questions you may have.
Thank you very much.